There's a floor in finance where the money stops being a salary and starts being a share of everything, where your bonus isn't calculated, it's negotiated, where the people above you don't manage companies, they buy them, restructure them, sell them, and walk away with returns that make investment banking comp look like a government stipend. Private equity is the quiet room behind the loud room. It's the place every analyst in every bank is trying to get into, and every person inside is trying to figure out whether the ceiling is real or just a longer hallway. The titles sound familiar: analyst, associate, vice president, principal, partner. But the game behind each one is completely different. The hours shift, the leverage changes, the politics get sharper, and the money, when it finally arrives, comes with a set of strings so intricate you'll need a decade to see them all. This is what it's actually like to live inside private equity. Every level, every trap, every reward, every version of yourself you'll have to become to survive the next one. 1. Analyst, the proving ground. You arrive, and you are immediately the lowest value person in a room full of people who were once the highest value person in theirs. Everyone here was top of their class somewhere. Valedictorian, summa cum laude. 2 years at Goldman or Morgan Stanley with a reputation clean enough to get recruited. And now you're all in the same bullpen, building models at midnight, wondering if you've made the right bet. The work is familiar if you came from banking, but the context is different. In banking, you built the pitch. Here, you build the thesis. You're modeling companies not to sell a deal, but to decide whether the firm should spend $300 million acquiring one. The stakes aren't theoretical. Every assumption in your LBO model has a dollar figure attached to it, and the partners upstairs will test every single one. Your day starts early and ends when the work is done, which is almost never when you think it will be. You're pulling data from Capital IQ, building sensitivity tables, formatting memos that will be read by people who've been doing this since before you were born. You're not being asked for your opinion yet. You're being asked for precision, speed, judgment under pressure. The ability to turn a vague thesis from a Monday morning meeting into a 40-page investment memo by Thursday. The culture is quieter than banking. Fewer people, smaller teams, no trading floor energy, just a clean office, expensive furniture, and an ambient intensity that never fully lets up. You'll work with 2 or 3 people on a deal, not 15, which means there's nowhere to hide. Every mistake has your name on it. Every delayed deliverable is visible. Socially, you're in a strange position. You're at one of the most prestigious firms in finance, but you're the junior person at the table in every meeting. When the firm visits a portfolio company, you carry the laptop bag. When a partner asks for a comp set at 9 p.m., you don't ask why. You just build it. The pay is better than banking, but not by the margin people imagine. Base is somewhere around $150,000 to $200,000 depending on the fund size, with a bonus that can push total comp past $300,000. It's good money for your age. It's also the last time your compensation will feel simple. From here on, every dollar gets layered in complexity. Carry, co-invest, vesting schedules, clawback provisions. You just don't know that yet. What you learn at this level is whether you can operate in a room where no one is going to hold your hand and the margin for error is almost non-existent. The work is real. The pressure is constant. And the question you're being quietly evaluated on isn't whether you're smart. Everyone here is smart. It's whether you're reliable when the room gets serious. You're not building a career yet. You're auditioning for the right to build one. 2. Associate, the real filter. If analyst was the tryout, associate is the actual selection round. This is where the firm decides whether you're someone they invest in or someone they let walk after 2 years with a strong resume line and a polite farewell dinner. Most PE associates come from one of 2 pipelines, promoted internally from analyst or recruited after 2 years of banking plus an MBA from a top 5 program. Either way, you've already cleared several of the most competitive filters in finance. And now you're inside the machine that actually makes investment decisions. Your role changes. You're no longer just executing models. You're shaping them. You're the one calling management teams to ask operational questions. You're the one sitting in on due diligence calls with legal, with accounting firms, with consultants the fund has hired to validate a thesis. You're starting to develop a sense of what makes a deal real and what makes it a polished waste of time. The workload is still brutal. 80-hour weeks are normal during live deals, but the texture shifts. You spend less time formatting slides and more time thinking. You're expected to have a view. When a partner asks whether the revenue projection is aggressive, you're supposed to have an answer and a reason behind it. This is also where the politics begin to surface. At the analyst level, the hierarchy is obvious. As an associate, you start noticing who has the partner's ear, who gets staffed on the best deals, who gets invited to the management dinner after the site visit, and who stays behind at the hotel. The meritocracy is real, but it's not clean. Relationships matter. Style matters. Whether a partner trusts your instincts on a Tuesday night call matters more than your GPA ever did. Compensation rises. Total comp for a mid-fund associate typically lands somewhere between $350,000 and $600,000, depending on fund size and performance. At the megafunds, it can go higher. But here's the catch. A meaningful chunk of your upside is now tied to carried interest, the fund's share of profits on successful exits. It sounds incredible on paper. In practice, it vests over years, often with conditions you won't fully understand until you're 3 funds deep. The golden handcuffs aren't visible yet, but they're already being fitted. Your social life compresses further. You're traveling more. Portfolio company board prep, annual meetings, industry conferences. Your relationships outside finance start to thin, not because of any single dramatic moment, but because you cancel enough dinners, miss enough weekends, delay enough plans that people quietly adjust their expectations of you. At this level, you begin to understand the real product of private equity. It's not deals, it's judgment, the ability to read a company, a team, a market, and decide, with imperfect information and real capital at stake, whether something is worth buying. The associates who advance are the ones who develop that instinct early. The ones who don't are shown the door politely, usually toward a corporate development role or a smaller fund where the hours are lighter and the carry is thinner. You're no longer proving you can do the work. You're proving you can think like an investor. And the difference between those two things is the difference between a career in PE and a resume that says you once had one. 3. Vice President. The invisible ceiling. You've survived the filter. You're a vice president now. The title sounds like a rival. Inside the fund, it feels more like the beginning of a longer, quieter test. At VP level, you're running deals. Not pieces of deals. Not sections of memos. The whole thing. You're quarterbacking due diligence work streams, managing the associate and analyst below you, coordinating with legal counsel, presenting to the investment committee, and, for the first time, sitting across the table from a CEO whose company the fund is about to acquire and being expected to hold your own. The skill set changes dramatically. Modeling still matters, but only as a foundation. What matters now is communication, persuasion. The ability to walk into a room with a management team that's skeptical, nervous, or openly hostile about being acquired and make them believe the fund is a partner, not a predator. You're not just evaluating deals anymore. You're selling the firm's vision to founders, operators, and boards, while simultaneously stress testing every number behind the curtain. Your calendar becomes your identity. Monday is IC prep. Tuesday is a portfolio company board call. Wednesday, you're flying to a target company's headquarters in Ohio for a site visit. Thursday, you're back in the office writing up your investment recommendation. Friday is a call with a placement agent about the next fundraise. Somewhere in between, you're managing 2 associates who need feedback, answering LP data requests, and trying to remember whether your dry cleaning is from this week or last. Compensation at this level starts to diverge meaningfully based on fund size. At a middle market fund, total comp might sit between $500,000 and $800,000. At a mega fund, KKR, Apollo, Blackstone, Carlyle, it can push past $1 million, especially in strong vintage years when carry begins to pay out. But here's the thing about carry, it's not liquid. It doesn't arrive on a schedule you control. You might be worth 7 figures on paper and still feel cash poor compared to a tech director at Google who gets RSUs on a predictable vest. This is also the level where the career question gets existential. The path from VP to principal is narrow. The path from principal to partner is narrower. And for the first time, you can see both the ceiling and the floor clearly. The ceiling is a partnership stake, a share of fund economics, generational wealth. The floor is a lateral move to a corporate strategy role, a smaller fund, or, quietly, humiliatingly, a portfolio company operating role that the firm frames as a great opportunity, but everyone knows is the exit ramp. The politics at VP level are no longer ambient. They are structural. You are now competing with 2 or 3 other VPs for a finite number of promotion slots. The partners above you are watching not just your deal performance, but your relationship management, your presence in meetings, your ability to represent the firm externally without supervision. They're asking themselves a very specific question. Can I put this person in front of a billion-dollar LP and feel comfortable leaving the room? If the answer is yes, you advance. If the answer is not yet, you get another year. If the answer is no, you get a polite conversation and a recruiting introduction. The hours are still long, but the exhaustion changes shape. It's less about raw output and more about cognitive load. You're carrying 5 things in your head at all times: the deal, the team, the portfolio, the politics, and the fundraise. You don't collapse at your desk anymore. You just never fully switch off. You are now, for the first time, genuinely important to the firm's operation, which would feel better if you weren't also, for the first time, genuinely replaceable in a way that matters. 4. Principal/director, the waiting room for power. Principal, or director, depending on the firm, is the last title before partner. It is also, by almost every account, the most psychologically complex level in private equity. You are, functionally, doing partner-level work. You're sourcing deals. You're leading investment committee presentations. You're sitting on portfolio company boards, not as an observer, but as a decision-maker who's expected to guide strategy, challenge management, and protect the fund's capital. You're flying to conferences and industry events not to learn, but to build relationships that will generate the next deal. And yet, you are not a partner. You do not have an equity stake in the management company. You do not participate in management fees at the same level. Your carry allocation, while real, is a fraction of what sits above you. The economics of the fund are designed so that the last step, the one from principal to partner, is worth more than every previous step combined. This creates a specific kind of pressure that is difficult to explain to anyone outside the industry. You are doing the work. You are taking the risk. You are the person the associates come to for guidance and the person the partners rely on to execute. But the reward structure is built around a gate you haven't passed through yet. And the people who control that gate are the same people you sit next to every day, whose moods you've learned to read, whose preferences you've learned to anticipate, whose deal preferences you've quietly shaped your own career around. Compensation at this level is strong by almost any external standard. Total comp for a principal at a large fund can range from $800,000 to $1.5 million, sometimes higher. Carry distributions, if the fund is performing, begin to arrive in meaningful amounts. You can afford things: a home in Greenwich or the Upper East Side, a car you don't think about, vacations you book but sometimes cancel. But the internal math is different. You know what the partners make. You've seen the fund economics. You understand that the gap between your comp and theirs isn't incremental, it's exponential. A senior partner at a top-performing megafund might earn $10 to $30 million in a good year, sometimes more. That number is not a secret. It's the gravity that holds the entire system together. At principal level, you also start to feel the weight of portfolio responsibility in a new way. When a company the fund owns starts underperforming, you're the one getting the call. You're the one flying out on a Tuesday to sit across from a CEO and explain that the board has concerns. You're the one negotiating management changes, operational restructurings, or, in the worst cases, the wind down of a failed investment that the fund will have to write off. These aren't abstract exercises. These are companies with employees, and your decisions affect their lives in ways that the spreadsheet doesn't capture. Your identity at this stage is almost entirely professional. You are the fund. Your reputation is your deal record. Your network is your pipeline. Your weekends are populated with casual dinners that are actually relationship maintenance for the next fundraise or the next co-invest opportunity. You are one promotion away from the thing that justifies everything. And that proximity, that closeness to the top, is both the most motivating and the most destabilizing thing you've ever experienced. 5. Partner/managing director. The room you couldn't see from outside. You made it. Partner, managing director. The title that every analyst, every associate, every VP, and every principal was oriented toward from the moment they walked through the door. The title that restructures your economics, your authority, your calendar, and, whether you expected it or not, your entire psychology. At partner level, you are no longer working inside the fund. You are the fund. Your name is on the pitch deck that goes to sovereign wealth funds and state pension systems. Your track record is cited in the fundraise materials. Your relationships with LPs, the limited partners who allocate hundreds of millions of dollars into the fund, are the reason capital flows in. Without you, the fund doesn't raise. Without the fund, nobody below you gets paid. The money is, by any reasonable standard, extraordinary. A partner at a well-performing megafund can earn anywhere from $5 million to $30 million annually, sometimes significantly more in strong exit years. The economics work like this. The fund charges a management fee, typically around 2% of committed capital, which covers salaries, rent, travel, and operations. On top of that, the fund earns carried interest, usually 20% of profits above a preferred return hurdle. That carry is where the real wealth lives. And as a partner, your share of it is no longer a sliver. It's a meaningful cut of a very large number. But here's what nobody tells you from the outside. Partner-level economics come with partner-level exposure. Your carry is tied to fund performance across a 10-year vehicle. If a deal you championed goes sideways, a portfolio company misses projections, a market turns, a management team collapses, it doesn't just hurt your reputation, it affects your payout. In funds with clawback provisions, it can literally reverse distributions you've already received. You are not playing with house money, you are playing with your own. Your days no longer look anything like what they looked like as an analyst. You are not building models, you are not running diligence. You are doing three things: sourcing deals, managing LP relationships, and sitting on boards. That's it. Everything else has been delegated to the team below you. The same team that watches your every move with the same mixture of admiration and calculation that you once directed at the partners above you. The sourcing game at this level is relational, not transactional. You're not cold calling companies. You're cultivating relationships with founders, family offices, and intermediaries over years, sometimes decades, so that when they're ready to sell, your fund gets the first call. You're attending the right dinners, sitting on the right nonprofit boards, showing up at the right industry conferences. The deal doesn't start in the model. It starts in a conversation you had 18 months ago at a restaurant in Midtown that you almost canceled because your flight from London landed late. LP management is the part of the job that nobody on the outside understands and everyone on the inside dreads. Limited partners, pension funds, endowments, family offices, sovereign wealth funds are the people whose capital you invest. They expect transparency, performance, and access. They want quarterly updates, annual meetings, and ad hoc calls when something goes wrong. They want to know why you paid 12 times EBITDA for a specialty chemicals company and when you plan to exit. They are polite, sophisticated, and relentless. And if you lose their confidence, your next fundraise gets smaller, or it doesn't happen at all. Board work is where your authority is most visible and most consequential. You sit on the boards of the companies the fund owns. You hire and fire CEOs. You approve capital expenditures. You set strategic direction. You are, in the most literal sense, the owner. And ownership, it turns out, is not a feeling of freedom. It's a feeling of weight. Every underperforming quarter is yours. Every missed hire is yours. Every market shift you didn't anticipate fast enough is yours. The associate can blame the model. The VP can blame the timeline. You can't blame anyone. Socially, the partner title opens every door. You are invited to everything. Davos, if your fund is large enough. Sun Valley. The right charity galas. The right private dinners. Your children attend schools where the other parents are people you've done business with. Your vacations happen in places where you'll run into someone from the industry, which means they are never fully vacations. And yet, for all of this, there is a quiet, rarely spoken truth about making partner in private equity. The race doesn't end, it just changes shape. Now you're competing with other partners inside the fund over allocation, over credit for deals, over succession. You're watching the founding partners above you for signs of retirement, calculating when a seat at the top of the table might open. You're managing your reputation not just within the firm, but across the entire LP ecosystem, where one bad fund can undo a decade of credibility. You wanted the room. You're in the room. The room, it turns out, has no exit, just higher stakes and a better view. 6. The view from the top. What nobody told you at the bottom. Here is what private equity looks like from above. It is a 10-year game played in 18-month increments. Every fund has a life cycle. You raise capital, you deploy it, you manage the portfolio, you exit, you return capital to LPs, and then you do it again. The entire structure of your career, your comp, your reputation, your relevance, depends on your ability to repeat this cycle, each time with more capital, better returns, and fewer mistakes. There is no coasting. There is no tenure. There is only the next fund. The people who survive to the top of this industry share a specific set of traits. They are disciplined to the point of compulsion. They are socially fluent but emotionally controlled. They are comfortable with ambiguity and allergic to excuses. They have an almost unnatural ability to sit in a room full of uncertainty and make a decision, not because they're certain, but because they understand that indecision is more expensive than being wrong. They are also, almost universally, tired in a way that doesn't show on the surface. The fatigue at the top of private equity is not the dramatic exhaustion of the analyst pulling an all-nighter. It's the slow, cumulative weight of decades spent making high-consequence decisions with imperfect information while maintaining the appearance of total control. It's the knowledge that your lifestyle, your family's lifestyle, your team's careers, and your LP's returns all sit on a foundation that you have to rebuild every 3 to 5 years. The money is real, the power is real, the access is real. But so is the cost. The relationships that thinned at the associate level never fully recovered. The hobbies you deferred at VP never came back. The version of yourself that existed before the fund, the one who read novels, who traveled without an agenda, who had friendships uncomplicated by deal flow, is someone you remember but no longer recognize. Private equity is, in the end, a system that converts talent into returns. It does this efficiently, elegantly, and without sentiment. It rewards the people who can tolerate its demands with wealth that most industries cannot offer. And it asks, in return, for something that no compensation structure can fully price: your time, your energy, your attention, and large portions of the life that exists outside the fund. Everyone below you thinks the top is the answer. Everyone at the top knows the top is just the question, asked louder, with more at stake, and with no one left to ask for help. Welcome to private equity, the carry vests eventually. Whether you're still the same person when it does is a different matter entirely. So yeah, we don't sell the dream. We walk you through the building and show you what each floor actually costs. Subscribe for a window into the tower.